As we move through the fourth quarter of what has really been a very interesting year, we wanted to come to you today, give you a brief review of what we saw in the third quarter of 2024, and then also give you some ideas of what we see going forward for the economy, as well as how we want to be positioned from an asset allocation standpoint. Let's dig right into what we saw in the third quarter of this year. It was welcome news to investors that the Federal Reserve finally had that pivot and cut interest rates for the first time since 2020. It didn't stop volatility, though. We saw volatility as measured by the VIX index spiking the most we've seen since the second quarter of 2022. But global investors really shrugged all that off, and we saw impressive equity returns in the markets. So let's look at this chart. What you can see is we started to see the equity returns broaden out from that large cap growth area. If you look at on the left side, you can see the Russell 2000, the Russell 2500, these value indices, these were the best performing asset classes within the U.S. equity market. And when you look at, for example, the S&P 500 equal weighted index versus that tech heavy market cap weighted index, it actually outperformed by the most we've seen in the past 7 quarters. These gains also went internationally. We saw a big rebound at the very end of the quarter in Asia, and that was primarily around China stimulus. But you can see the returns were pretty broad-based across both developed and emerging markets. When you look at the bond market, bond returns also were positive in the quarter, and that's because you finally did get that Fed cut in interest rates. The economy started to show signs of slowing, the labor market's weakening, and inflation has been moderating and coming down closer to that Fed's target. So you saw bond returns do well. You saw long-term bonds do better than short-term bonds. And then from a commodity perspective, it was a very mixed picture. You can see that energy prices were substantially lower during the quarter, primarily because of the fact that there was concern and uncertainty about the global growth perspective going forward. But you saw some other things like precious metals rally significantly, specifically gold. That's been driven by geopolitical tensions, the uncertainty around the elections here in the U.S., as well as the uncertainty around the global debt picture. And it's not just a U.S. deficit, U.S. debt picture that caused gold prices to rally. You have a global debt problem that continues to support gold prices.